Hello, investors. My name is Stuart Cruz, and welcome to Cruz Asset Management's video chart of the day. And today we're going to be talking about general economic indicators. So right now I have a chart of the U.S. personal savings rate. And as you can see by this dotted line right here, the average savings rate is about 6.33%. But we hit an amazing savings rate at a high of 33.5% during the lockdown, which somewhat makes sense. People can't go to work and they can't go to stores and they can't go to concerts or fly, then they're saving money. Now, on the other hand, if I'm going to add US unemployment rate onto this chart, which just came out today at a print of 10.2% unemployment, and we're going to talk about that a little bit later. If there are a lot of people that are employed, how are they saving so much money? Well, of course, the answer is government spending. You can't spend any money, and they put a lot of provisions in place so that it was harder to actually spend money. So people were saving money, which can be a good thing when you have an economic slowdown. And hopefully this cash on the sidelines will do good things to help generate interest and velocity in the economy. But it almost looks as the unemployment itself caused the high savings rate, which clearly they're correlated or related. Okay, so if we're going to look at this, where is this money going to? Well, I'm going to add a U.S. mortgage rate on top of this savings rate. And what we've seen is the U.S. mortgage rate hit an all-time high of $9.7 trillion. I'm sorry, not U.S. mortgage debt. That's how much debt that the U.S. is taking on in mortgage. And let's clean up this chart a little bit because I'm going to add a few more lines. So here's the U.S. mortgage debt, $9.7 trillion, and that's probably a result of the savings rate as well as the U.S. 30-year mortgage rate. The amount that the average person is able to collect a mortgage for has come down to below 3%. So you can get a 30-year mortgage on an average credit line for under 3%. So that would really encourage a lot of mortgage debt to be taken on, and that's what we've seen. And, well, we've had high levels of unemployment. So what does that mean to our delinquencies? Well, of course, we've been able to kind of furlough some of these mortgage payments. So our delinquencies are pretty well handled. Back during the financial crisis, we had delinquencies in the first quarter of 2010 as high as, looks like, almost 9%. But now they're just over 1%, which is really kind of all-time lows. That's generally what we see around here is about a 1% delinquency rate, and that's what we see right now. So, so far, looks like people are paying their mortgages. That said, it looks like the government stimulus program could start running out or at least be restricted. So we need to keep an eye on some of these delinquency rates. So again, I'm going to clean up this chart a little bit. Right now we have the U.S. mortgage debt, and I'm going to add total U.S. household debt, which will be a bigger number because you have mortgage debt plus all the other debt. So that's credit card debt and any other unsecured debt that you have on your balance sheet. And what we see is this spread. Now I took the liberty of creating a spread down here between these two figures. So what we see is our total debt is increasing, our mortgage debt is increasing, but the difference between the two just took a down tick. So what that means is our unsecured debt is getting a little bit better, which makes sense because the savings rate went up. So our unsecured debt is lower. So you kind of have good debt and bad debt. And I would consider mortgage debt at below 3% to be pretty good debt. Because if you have a mortgage on your house, the asset of your house is leveraged and it usually appreciates around inflation or so. And if you're only paying 3%, but you can get, I don't know, maybe a 3% return on your house, but it's leveraged 5-to-1, then that return actually becomes 15% return on your money when you're only paying 3%. So that improves people's balance sheets as well over the long term. So what we see here is a tick down of unsecured debt because the total debt is not rising as fast as the mortgage debt. All right. Now, of course, where's all this coming from? Well, it's coming from our federal government funding it through U.S. public debt. So our federal government's U.S. public debt is being funded, and we had a video chart of the day a little bit earlier on this, and I will put a link to this, but in here where we talked about it in more detail. But our U.S. debt is at $23 trillion. The both sides of the aisle right now, Republicans and Democrats, are talking about whether we're going to add another trillion or three onto that number. And if we add our U.S. GDP onto this, back here in 2012, we crossed over 100% debt to GDP. And here, if we divide our 23 by the 19.4, because our GDP took a 32% hit in annualized terms, now where our debt to GDP number is 1.2%. Now, that could mean inflation down the road, which again is another reason why you might be looking at gold, and gold prices have been spiking here and just hit an all-time high. So our gold prices are here. We hit an all-time high recently, and that could be the market anticipating future inflation, a hedge against volatility, and a hedge against perhaps if some of these interest rates go up, that would mean multiple compression in the stock market, which would drive the stock market down. And so when you have higher inflation, then bonds would be a terrible place, cash would be a terrible place, stocks would see some headwinds, but commodities like gold and real estate should do well because those hard assets are what inflate during inflation. Okay, so maybe if you don't have a little gold, that's now time to add. So generally what we're basically saying is the overall economic conditions look pretty favorable, with the one exception, and I'm going to put in a completely muddled chart, with the one exception of our public debt going crazy right now. So what that means is things look pretty good, but if the government stops spending money, and in this system that we have, which is a capitalistic system, at some point they're going to have to stop spending money. With a high level of unemployment, which is higher than almost any other unemployment print that we've ever seen, we could start seeing some issues in the economy. So stay tuned and stay vigilant, and don't forget to invest with the odds in your favor.